Obviously. Hey, so we're going to be talking about gas prices real quick. Just kind of give everybody a little bit of a sense of your background on this in relation to this topic, and just sort of what qualifies you to talk about it, or what has sort of piqued your interest in engaging in this topic and some of the things that you've written about on your website.
Sure. I am not an oil person per se. I want to be clear about that, nor am I an economist. What I am is a business person. And I have an MBA from Harvard and a degree from MIT. And I do a lot of thinking about business from the perspective, I'll call it from a systems perspective. What are the things that drive business? What are the things that enable businesses to grow, and by how much? And how can you figure this out? So, so purely as a mental challenge to myself, one of the things that I'm always looking for are simple mathematical ways, using usually elementary school math, to figure out what's going on in a business from reported information. And what I've discovered is that people often don't understand how people don't know accounting. They don't know a lot about the way that numbers in business work. And so you can tell an awful lot about a business by just looking at the numbers. And in the case of oil prices, you can take a look at the numbers and how they're changing and what's going on with them. And you can make some assumptions about the way that the companies are being managed and to what goals, et cetera.
So I came across an article that's on your website. We're having a big conversation in the country right now regarding oil prices. There are a lot of people who believe that oil companies are price gouging American consumers right now, because we're seeing this rise in oil prices again, but the oil companies are making record profits. And we have people within the administration, the Biden administration, and others saying that the companies are simply price gouging consumers. You give a few examples on your website about how oil pricing actually works, and how many of the oil companies operate on a business model where they care about the they care about the profit as a percentage of sales, not just a raw dollar profit. So can you kind of explain a little bit more about that methodology and how that is applicable to this situation?
Sure. Want me to do the whole spiel and try to go through my whole analysis here? Because it's all right. All the pieces are connected. So first of all, when the way that most people think about investing, and we'll apply this to oil in just a minute, is what return are they receiving on their money? And what the return is, if I put $1 into my bank account today and I get $1.25 out at the end of the year, or I won't say my bank account, if I put it into an investment, I say it's a 25% return, because I got 25 additional cents on top of $1. 25 divided by 100 is 25%. It's 1/4. So what we care about when we're investing, and when I say we, I don't just mean businesses, I mean us as individuals, we care about, for every dollar we put in, how much do we get out? And if we put in $1 and we get out $1.25, we're making a 25% return on our money. If your money is in a mutual fund, if it's in an index fund, I mean, you're like retirement savings, then you probably look at that. And when your statement comes at the end of the month, it says your fund returned 10% last year. And so what that means is, if you put $1 in at the beginning of the year, you took $1.10 out at the end of the year. Now, what's going to happen if this year your fund returns 10%, but next year your fund only returns 2%? You're going to be like, boy, I don't like this investment anymore. I'm going to take my money out of this investment and put it in a different investment where I can get a 10% return again. So the way that you make your decisions, and the way that companies make their decisions, professional investors make their decisions about where to put their investing dollars, is they look at the percentage return. If the percentage return goes down, then often people will say, okay, now that I'm getting a lower return, why keep my money here? I'm going to put my money in something that gives a much greater return. And that's the fundamental investing question, is looking at percentage return. And we want that percentage return to stay as constant, or preferably even grow. So that's the key to the way that we make decisions when we're talking about being on the investor side of the equation, which, again, if you have money saved for retirement and you have it invested in the stock market, that's what you're doing. You're expecting a percentage return. Here's the interesting trick about, and this doesn't just apply to oil companies, this applies to any company whose raw material costs are going up. And I'm going to explain this first qualitatively, and then I'll walk through an example with numbers if you'd like to do that. So qualitatively, if your raw material price goes up, let's say from $1 to $2, then if all you do is increase your price, by one additional dollar. So you keep the actual number of dollars the same. As a percentage, that goes down. So instead of it being a 25% profit, it's now going to look like a 20% profit. I'm just making these numbers up. I'll walk through a real mathematical example in a moment. So when people say, oh, look, raw material prices, in this case, oil, have gone up by 10 cents, say 10 cents a gallon, why can't we just raise prices at the gas pump by 10 cents? And the oil companies will not be having record profits. They'll be having the same profits that they had last year. But consumers will be getting basically the lowest possible price that they can, given the increase in raw materials. And the answer is because if all you do is increase the top line income by the same amount as your costs increased, your percentage return will actually go down. So to investors, it's going to look like, hey, this gas company that made 25% last year, even though it's making the same number of dollars profit, it's now making only 10% profit this year, or whatever the number actually turns out to be. Therefore, it's a bad gas company, and we should not invest in them. So interestingly enough, our insistence as consumers that we get a constant percentage return or a growing percentage return for our money in terms of profitability, that thing that we all want as consumers, means that if oil prices go up by 10 cents, gas prices need to go up by 11 cents in order to keep the percentage profit the same. Now, I just threw a whole bunch of different numbers in there and kind of made stuff up. Let's go through an example using some actual numbers. These are not actual oil numbers. These are just concrete numbers. Let's say that you have, we'll go ahead and use oil. Let's say you're selling oil and you're selling gas, and gas is $2 a gallon. And of that $2, the oil price in that gas is $1 of that. So that means for every gallon of gas sold, it's sold for $2. The oil price is $1, so there is $1 of profit being made. Now, for those of you finance geeks who are listening to this, I know it's not profit, it's gross margin, and blah, 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 all that, whatever. We're doing the simple version. So you sell $2, it costs you $1, and you make $1 in profit. Now, let's say that oil prices now go up by 50%. So now oil is $1.50. Oh, wait a second. So in the previous example, or in the previous thing, so you had a $2 gas price. $1 of it was raw materials, which left $1 of, we'll call it profit. That's 100% profit, right? It's 100% of your costs you just made in profit. So now let's say that oil prices go up 50%. So now for every gallon of gas that you're selling for $2, oil costs $1.50. Well, if you want to keep the absolute amount of your profit, which was $1, the same, you would increase gas prices to $2.50. So oil prices go up by 50 cents, you increase gas prices by 50 cents. And now you're selling gas for $2.50. And what you're making is $1 worth of gas, or is making $1 worth of profit. However, you're making that profit on top of $2.50. So instead of it being 100% profit, it is now, what is 1 over 2.5? It is now 40% profit. So your profits just dropped from 100% to 40%. That does not look good. That doesn't make management look good. The investors are going to go, wait a minute. I mean, that looks really bad, even though your dollar profit is the same as you made the previous year. So let's be very clear about that. In terms of dollars in your pocket, you're making the same amount of money. It's just because of how we evaluate investments that now is looking like only a 40% return instead of 100% return. So in order to get back to that 100% return, that we have to charge $3 a gallon. So gas went up from $1 to $1.50. We need to preserve our 100% return on that. So we double the price for $3 a gallon. So a 50% increase in the cost of oil just caused the price of gas to go up by an entire dollar, by 50%. And the reason is because in order to do that, in order to preserve the 100% profit, we need to increase the the top line by more than just the cost of the oil. Now, here's where the record profits piece comes in. When people are talking about record profits, they don't mean record profits as a percentage. Profit as a percentage may in fact have stayed exactly the same, but because the percentage is on a larger top line amount, the absolute dollars is much larger. Because again, even though we're just having 100%, we're using the 100% as our profit number here, the amount of profit, well, we had $1.50, which is the new higher price of oil. We sold it for $3. We now made $1.50 profit. Well, that's way more than we've ever made before. Previously, we were only making $1. So in absolute dollar terms, we can be making record profits, but in fact, we're just holding steady at our percentage returns, which is what investors, including us, are demanding. Now, if you want to get to the current situation and ask, are oil companies price gouging, you actually would need to run the specific numbers, which I have not done, and say, okay, if oil companies are charging, and I'm going to stick with the same example, if oil companies are charging $3 from that 50% increase in gas, then in fact, the reason that they are having record profits is because they're simply trying to maintain the same percentage profit margin that they had before because our stock market and our investors demand it. If we're willing to accept lower returns, then they would be able to only increase it by the actual increase in oil. If, however, let's say they say, well, you know what? Inflation is going on. We're going to charge $3.50. In the case of charging $3.50 a gallon, when oil prices have only gone up 50%, now they are price gouging because they increased the price of oil $1.50. They increased the price by 50 cents to cover. Wait a minute, am I doing the math right? There's a chunk of the increase that is simply going to preserving the percentage return, but then they're actually charging above that. It's the charging above that that's the price gouging. And like I said, I'd have to sit down and actually look at income statements, and I haven't done that. But conceptually, it is absolutely possible to be showing record profits and to not be price gouging, because all you're doing is preserving the profit margin that the market and the consumers and the investors are demanding that you maintain.
So this has been an incredibly volatile year in terms of oil and gas prices. Do you think that part of what's going into the pricing mechanisms for these companies is sort of planning ahead and hedging against future price increases?
It could be. This is a question I would actually say, find an oil company executive, because I don't know how they do their risk management and their forecasting. I do know that as a business person myself, and now I'm speaking purely hypothetically, if I was in an environment where I had really volatile raw material prices and I was thinking, you know what, I need to lock some stuff in here because this is just too dangerous. I don't know if things are going to whipsaw in one direction or another. I would certainly be planning X number of months out, whatever is appropriate for my industry. And I would be trying to lock up oil futures and, whatever it is that I could get to lock in the price today to make sure that I was getting, at least my raw materials at a reasonable price. But also, and I want to stress, this is not my own personal morals or ethics, but I hate to say this, but the rule of business is maximizing profit. And even at the expense of your customers and the expense of society, et cetera. I mean, that's the way we've set the game up. I happen to think there's some flaws in that. But if I were a business person who had a fiduciary responsibility to the owners of the company to maximize profits, and I thought that I could raise prices and keep them raised, I would do that. And I think that you're seeing that consistent across industries. Every time companies raise prices for some temporary thing, they don't bring them back down again, generally speaking. Prices go in one direction and one direction only, which is somewhat dangerous, because what that means is that if we as a society need certain things to be cheaper, or we need certain industries to, if an industry temporarily raises prices for an oil shock or something, and we need to go back down again, we need to have a mechanism, which we don't currently have in our economy, short of actually being bad business people. We don't have any societally and business acceptable methods for business to decrease their profit margin in cases where where they need to. We just have to rely on the largesse of the executives. And in fact, we can see this with Pfizer right now. Pfizer has recently announced that they're planning on, I think, tripling or quadrupling the cost of COVID vaccine from $30 a dose to $120 a dose. And that's going to put the vaccine out of reach of a tremendous number of people who, people who aren't insured, especially. And I would argue that as a society, we want that to not happen. But we don't have any mechanism for that to not happen except to subsidize the company that we want to have lower prices, and to subsidize the purchase of things from the company. And I think that is a notable failing in our economic system. And I do not have an answer to pull out of my back pocket. I can simply point fingers and say, this is a design flaw without knowing how to fix it.
So I'm seeing right now that the Biden administration is considering taxing oil companies to sort of tax away the profits. What do you think the impact is going to be to the oil companies and the consumers?
Yeah, as we were discussing before, this tax, like the economics of taxation, is not. I really don't know exactly how that works. I'm sure there's a large body of literature on it, but my impression is that if you're going to raise taxes on a company, the company can just raise their prices to recoup as much of those taxes as they want. I mean, it's not, it's what the market will bear. And in the case of oil, people need oil. I mean, and when I say oil, I'm actually thinking gas. I mean, that's how my mental model is that from a consumer's point of view, it's primarily going to be heating oil and or gasoline that are the ways in which we most consume oil. And if the government decides to tax that, the companies can simply raise prices unless they're regulated in a way that prohibits them from raising prices, because why not? If they want to take the same amount of money home at the end of the year, it's not like I have an option to not buy gas for my car. We have a physical infrastructure in America that depends upon single or multiple person automobiles, and short of riots in the streets, it's very hard to get gas prices down if companies don't lower the gas prices, and it's entirely in the hands of the company. So, I think we'll see some market dynamics play out around there. And as far as how much of that will be passed on to consumers, obviously the oil companies can afford to pay it, or the Biden administration wouldn't be considering it. But again, my observation, and this is not an ideological statement, this is an observational statement. My observation is that if companies decide not to pay taxes, they'll do everything in their power not to. I seem to recall reading that Amazon paid no taxes in 2020 and 2021, which were years that made Jeff Bezos personally $100 billion, and all from his Amazon stock. So, I would suggest that it's really people from inside the industry and inside the companies you'd have to ask to find out how they're going to respond, because they have the power to respond any way they want to.
And real quick, where can everybody find you online?
You can find me at steverrobbins.com, STEVERROBBINS.com. And I generally work with high performers and people who are being considered for executive positions within companies. And I help them understand how to do basic business analysis, how to understand strategy, turn it into operations, and how to be better business people.
Awesome, brother. Well, thanks for taking the time to talk with me. I appreciate it.
Sure thing.